This episode is about using losses, the trading allowance, and reinvestment correctly. Losses, secondary trading income, and business reinvestment are frequently misunderstood in online tax advice. We will look at 4. Company losses, sole trader and partnership losses, the £1,000 trading allowance, and what reinvesting profit really does. A bad trading year does not always mean the tax value of the loss disappears. The options depend on whether the business is a company or an unincorporated trade. A limited company can normally use a trading loss against other profits of the same accounting period. An available loss can generally be carried back against total profits from the previous 12 months, creating a corporation tax repayment where tax was paid. Losses can also be carried forward and used against future profits, subject to the detailed loss relief rules and restrictions for larger groups. When a company permanently stops trading, terminal loss rules can allow certain losses from the final period to be carried back further, generally up to 3 years. The order of claims and the accounting periods involved matter, so this should be calculated before the final company return is filed. Sole traders and partnerships have different choices. A trading loss may be carried forward against future profits of the same trade. In some cases, it can be set against other income of the same tax year or the previous tax year, which is often called sideways loss relief. There are extra conditions and restrictions, including rules requiring the trade to be carried on commercially with a view to profit. A hobby that repeatedly loses money is not automatically a tax refund machine. Now consider a small secondary trade. The trading allowance can exempt up to £1,000 of gross trading and miscellaneous income in a tax year. Gross income means money received before expenses, not profit after costs. The £1,000 applies across relevant trades rather than separately to every small activity. If gross income is £1,000 or less, you may not need to tell HMRC, although there are exceptions. You might still need to register to claim a loss, pay voluntary national insurance, claim certain benefits, or meet another reporting obligation. Where income is above £1,000, you can normally choose between deducting actual allowable expenses or claiming the trading allowance instead. You cannot claim the full allowance and then deduct the same business expenses again. Choose the method that produces the correct and most beneficial taxable profit. Finally, let us correct one of the most misleading phrases in business tax content. Reinvesting profit means you avoid corporation tax. Simply leaving cash inside a limited company does not remove corporation tax. The company still pays tax on its taxable profit. What can reduce taxable profit is spending money on genuine deductible business costs, such as staff, marketing, training, professional services, or repairs. Capital purchases may qualify for the annual investment allowance or another capital allowance, as covered in Episode 1. Some expenditure creates an asset or future benefit and follows different tax rules, so spending £10,000 does not always mean taxable profit falls by that amount immediately. Keeping post-tax profit in the company can delay personal tax because you have not yet taken the money as salary or dividends. That can support working capital and future growth, but it is tax deferral, not the cancellation of corporation tax. The strongest approach is commercial first and tax second. Spend where it genuinely improves the business, keep proper records of losses, and use the relief that the law provides. The final episode covers the point where all of this planning comes together: selling, closing, or leaving the company. For help using losses and allowances correctly, contact ABC Business Services. You can speak directly with a member of our team, email us to arrange an appointment, or visit our website for more information.